Welcome to the Deep Dive. Today we're cutting straight through the usual noise. We're diving right into the strategic heart of a major player, the Q3 2025 opening remarks from CFO Brian Brown.
Yeah, and our goal here isn't just, running through the numbers. It's really about looking at the blueprint for a huge corporate shift. I mean, this is a company trying to fold in two massive acquisitions, Redfin and Mr. Cooper, while dealing with a pretty tough housing market.
Right.
So the CFO's comments, they're basically the roadmap for how they plan to build stability, resilience, no matter what interest rates are doing.
Okay, let's just jump right in then. Q3 performance. If it was a test of just executing right now, seems like they aced it.
Oh, absolutely. Yeah.
The big headline is that revenue beat. Adjusted revenue hit $1,783 million. That's, well, quite a bit higher than the top end of their own guidance. Pretty strong start.
It really is. And the volume underneath that number, it backs up the operational strength. Net rate lock volume hit $36 billion.
$36 billion, wow.
Yeah, and what's really important there is the momentum, right? That's up 26% just from the previous quarter and 20% higher than the same time last year.
Okay, that kind of growth, it sounds great on its own, but the overall market's been kind of sluggish. So what's the strategic takeaway from those volume numbers?
It's market share capture, plain and simple. Their growth, it just blew past the wider market, both in purchase and refinance.
Yeah.
The CFO, he made a point of saying Q3 was their biggest quarter for both purchase and refi in over 3 years. So this isn't just, catching a rising wave. It's actively taking share while things slowly recover.
But, fast growth like that, sometimes it costs you. Did they have to slash margins to get that volume? What did profitability actually look like?
Well, that's the impressive part. They kept margins remarkably stable. Gain on sale margins held right at 280 basis points, which was, basically the same as the quarter before. And just so you listening know, 280 basis points, that means the profit they make on each loan they originated stayed steady, even with that huge jump in volume and, the market shifting around.
Right. And when you put that stable margin together with their operational efficiency, how did that look on the bottom line?
Looked very good. Adjusted EBITDA came in at $349 million. That translates to a 20% margin.
20%. That's quite a jump from Q2.
Oh, yeah, sharp jump from 13% the quarter before.
Huh.
And adjusted diluted EPS was 0.07 cents. The real key here is they didn't trade margin for volume. They used their tech, it seems, to handle the volume efficiently. So it flowed right through to EBITDA. Really good execution.
Now, here's what I think is the really interesting part. The driver behind it all. This is where market timing, maybe a bit of luck, comes in. The CFO was super specific about what drove the outperformance. It was that mid-quarter volatility.
Exactly.
He pointed out early July, 30-year fixed rates were hovering around 6.7%. But then, by early September, they'd dropped to about 6.3%.
Right, and that 40 basis point dip over a pretty short window, especially how it was concentrated in the back half of the quarter, that just lit a fire under refinance activity. And the broader market, well, it just wasn't set up to react that quickly.
Okay, so what let them grab that opportunity so well? Because, everyone saw rates drop, right? But not everyone posted market share gains like that.
It comes back to their tech capacity. The CFO gave a lot of credit to their investments in AI tools. He said that let them scale up capacity really dramatically, almost instantly actually, to meet that surge in demand. That kind of operational flexibility, that's what really sets them apart, lets them jump on these short-lived chances. And we also saw their home equity product momentum actually doubled year over year. So they're diversifying a bit too, beyond just the standard refi stuff.
So, okay, execution was sharp. That kind of sets the table for the bigger picture strategy, right?
Sure.
Capital structure, those big integrations. Let's talk Mr. Cooper first. They got the financing sorted out well before the deal actually closed on October 1st, didn't they?
Oh, absolutely. Very proactive. They issued $4 billion in unsecured notes way back in June.
Right.
And that was, well, a really critical move, financially speaking. The main reason was to simplify the capital structure after the acquisition. It let them refinance Mr. Cooper's old debt and pay down some of their own existing MSR debt once it all came together.
MSR debt, mortgage servicing rights. So the value of collecting those future payments. So that bond issuance basically cleaned things up right from the start. What's the war chest look like now, post-close, including Mr. Cooper's balance sheet?
Yeah, good question. As of October 1st, their pro forma available cash was pretty strong, around $4 billion, and total liquidity stood at about $11 billion.
$11 billion. That's
It
substantial.
is. And that level of liquidity, it's a major strategic plus. It gives them the cushion they need to make sure that huge Mr. Cooper integration goes smoothly, without any unexpected money problems popping up.
Okay. Now, switching gears to Redfin. That integration's been going on a bit longer. The big promise there was always tapping into Redfin's huge online reach, right?
Yeah.
Almost 50 million monthly active users, MAUs. The CFO talked about the get pre-qualified button usage. Is there actual proof the synergy's working there?
Yeah, the metrics are actually running ahead of their own internal forecasts. The number of Redfin users who actually started an application, click that get pre-qualified button, it more than doubled. It passed 500,000 applications by September.
500,000, wow.
That's serious lead funnel activation right there.
But the metric everyone really watches is that mortgage attach rate. The percentage of people buying a house through Redfin who actually end up using Rocket Mortgage. That's been tough historically, hasn't it? What's the latest there?
It's climbed pretty significantly, from about 27% when the integration really kicked off up to nearly 40% now.
40%. Okay, that is moving fast.
Very fast. Their stated goal is 50%, and they're tracking way ahead of schedule on that. And this is just, 4 months into the deep collaboration?
40% is great, definitely. But Redfin users, they're known for being pretty loyal to that platform, right? They like things simple. What's stopping them from hitting 50%, like tomorrow? And are they sure they can keep climbing?
Well, the CFO's confidence seems to come partly from the cost side, the expense synergies. They confirm they've already actioned most of that planned $140 million in annual savings.
Okay, so the savings are locked in.
Pretty much. The savings are real. They're permanent. So they believe the revenue synergy target, that $60 million over 2026, is totally doable because that attach rate is proving, easier to influence than maybe they first thought.
Excellent. Okay, now, Mr. Cooper again. Closed October 1st, so we only had about 30 days of data baked into these Q3 remarks. What's the initial read on integrating that huge servicing piece?
Yeah, early days, but the focus is laser sharp. It's all about plugging that massive servicing portfolio they just bought directly into Rocket's existing recapture engine.
Makes sense.
The planning for that started 6 months before the close, which apparently made for a really smooth transition day one. And just 30 days in, they're saying they already see strong momentum. Higher conversion rates on leads coming from that Mr. Cooper servicing book.
So it's already working.
Seems like it. It proves the immediate value, right? Using data, using AI to turn existing servicing clients into new loan originations. That's Rocket's bread and butter, really.
And that operational merger, it feeds right into the CFO's main strategic point. This combined company is a stronger Rocket, a company in a category of one. Let's break down those 3 pillars he laid out for this new, more durable business model.
Right. These 3 pillars, this is the why for investors, essentially.
Yeah.
Pillar 1 is stability. And that's really anchored by the combined servicing portfolio. It's now the biggest in the industry, and it throws off $5 billion in stable recurring cash flow every year.
$5 billion recurring. That's a huge stability claim. What's the sort of the killer proof point that this model can actually handle, say, another big rate hike cycle or a housing downturn?
Yeah. He gave a really interesting look back. He calculated that if you put Rocket and Mr. Cooper together on a pro forma basis going back, the combined company would have actually delivered positive GAAP earnings every single quarter from early 2023 right through Q3 2025.
Wow. Every quarter.
Through that period.
Every single quarter. And that period, I mean, you could argue is the toughest mortgage market we've seen in, decades maybe. So showing positive GAAP earnings through all that, that's probably the strongest possible case for the stability of this new combined model.
Yeah, that definitely makes the stability feel real. Okay, pillar 2, the growth platform. How does just the sheer size of the combined operation translate into future growth?
Well, it creates the industry's biggest purchase funnel, hands down. They're reaching 62 million monthly active visitors across their platforms. That means they're touching something like 1 out of every 5 potential home buyers in the U.S.
1 in 5. Okay. And that huge funnel at the front end, it constantly feeds into that really strong recapture engine, which now tracks almost 10 million homeowners they service. And that engine, using all their data, keeps their recapture rate at about 3 times the industry average.
So huge reach up front combined with really sticky customer retention or recapture on the back end. Okay, that brings us to pillar 3, cost advantage. And this is where the CFO made that pretty bold claim about technology, right?
Yeah, audacious might be the word. He was incredibly specific about how AI is driving down their cost per loan, their unit economics. He said that tech has boosted the capacity of their production staff, loan officers, processors, so they can handle 63% more loans now than they could just 2 years ago.
63% more capacity per person.
Per person.
Wow.
And that measurable efficiency gain, that's what he called the foundation for infinite capacity.
Infinite capacity. I mean, that's a massive statement. How does he justify that? How does tech really eliminate the human limit?
It's all about operating leverage. If your team members can handle 33% more volume, but their salaries or the office costs don't go up proportionally,
Right.
the company gets huge operating leverage. The CFO put a number on it. Once their fixed costs are covered, he estimates 70 cents of every extra dollar of revenue drops straight to EBITDA.
70% flow through.
Exactly. That structural cost advantage means every bit of growth they achieve becomes highly profitable. That's the thinking behind infinite capacity. The marginal cost of growth becomes very low.
Okay, let's shift to the outlook then. Q4 is the first full quarter with everything consolidated. What's the top-line revenue expectation for the whole combined company?
Yeah, the guidance they gave for adjusted revenue is a range between $2.1 billion and $2.3 billion. That's the new consolidated baseline, factoring in Mr. Cooper, Redfin, the synergies, the costs, everything.
And just taking the temperature of the original core business, just Rocket itself, without the acquisitions, is that still holding up okay on its own?
It is, yeah. The standalone guidance suggests they're still gaining market share. For the core Rocket business, adjusted revenue at the midpoint should be up about 7% year over year. That's pretty solid, especially considering, Q4 usually has that holiday seasonality slowdown.
Okay, now the tricky part, expenses. The total consolidated expense guidance for Q4 looks pretty high. It's set at $2.3 billion. That kind of number can definitely make investors nervous. We need to unpack what's actually in that number.
Yeah, this figure is super important to get right because it is complex. That $2.3 billion total expense guidance, it includes two really big chunks that aren't really part of the company's normal ongoing operating costs.
Okay, let's break those down. What are the two big items?
Okay, first, there's $140 million listed as one-time transaction-related costs.
Right, like deal fees, severance.
Exactly. Integration fees, maybe some legal stuff. It's real cash going out, but it's non-recurring. It won't happen again next quarter. Second, there's $120 million of new amortization of intangible assets. This comes directly from the Redfin and Mr. Cooper deals.
Amortization of intangibles. Okay, that's a non-cash accounting thing, right? It's like spreading out the value of the brand names or customer lists they bought, but actual cash isn't leaving the building today because of it.
Precisely. It hits the GAAP income statement, but not the cash flow statement in the same way. So if you take that $120 million non-cash charge and the $140 million in one-time costs, you strip those out.
Okay.
You see the underlying operating expenses. The sort of true run rate for the core business is actually expected to be around $2 billion.
So the real cash operating cost structure is actually like $300 million lower than that big $2.3 billion headline number suggests. That's a really vital distinction for anyone trying to honor cash flow.
Absolutely critical distinction. And the CFO also flagged about $215 million in interest expense for Q4. That's related to the unsecured debt they took on back in June and their MSR financing facilities. It reflects, the higher cost of carrying this bigger consolidated business.
So this was definitely a deep dive into a company that's fundamentally reshaping itself. The CFO, I mean, he laid out a really strong case for building this durable model, right? Unifying origination, the real estate connection with Redfin, and that massive servicing arm, all designed to thrive, theoretically, no matter what the market's doing.
Yeah, it was a very strategic narrative, less about just hitting quarterly numbers, more about proving the concept, showing those tangible proof points.
Yeah.
The Redfin attach rate climbing, the early wins converting Mr. Cooper leads, and that tech capacity to handle big volume swings. They clearly feel like they're moving beyond just reacting. They want to set the new standard for how housing finance works.
It leaves you with a big question, though. If they really can achieve something close to infinite capacity using AI, like they claim, what does that actually change about how growth works in finance? I mean, if you theoretically remove the human bottleneck, what does that unlock? What new strategies for pricing, for risk, for expansion suddenly become possible? That's the really provocative thought lingering behind these remarks, I think. What stands out to you? Thanks for joining us for the deep dive. We'll catch you next time.